Good afternoon, ladies and gentlemen, and good day if you're watching this at a later time on YouTube. Welcome to the JSE's Stock Picks. My name is Sam Okorosi. I am Head of Origination and Deals at the JSE. We've got a fantastic show for you this afternoon where we will be unpacking some great opportunities for investment in our small caps section. We are passionate about small and mid caps at the JSE. We think that they are the future of our markets. And so, like Anthony always likes to say, if you can pick right, you can pick some acorns that can become giant oak trees. And so with that, let me start with you, Anthony. Anthony Clark is of course, an independent analyst at Small Talk Daily and specifically focusing on small caps. Anthony, why don't you, as an intro, let the folks know something that maybe they don't know about you as yet, as an icebreaker.
Yeah, hi, Sammy. Thank you for allowing me to come back. Welcome to everyone listening to this online from a sweltering hot Cape Town. It's 30 degrees today. I'm in my office here, piled up with newspapers and press cuttings. The dog is sleeping to my right. What wouldn't people know about me? Well, I've been in the market for 30 years, but before that, I'm a qualified electrical engineer. And the last project that I worked on for a large American company was actually designing the machines and all the software that actually made the bonnet for the Opel Opel Corsa vehicle. So that was my previous incarnation until I retrained myself to go back to varsity to enter the stock market in 1991. So despite the fact that the picture that JSE is kindly using for this stock picking segment makes me look like a child, I'm actually a great deal older than I look.
Oh, good. Opel Corsa, that was quite an iconic car from all of our youths. I'm sure. That's a great story, Anthony. Why don't you pop into the three companies that you've got for us and let us know what's interesting. And a reminder to the folks watching us live on YouTube, please throw your questions in there, and the experts will be happy to answer them. Let them come in quick. Otherwise, sometimes what happens is that once we've moved on from one speaker, suddenly all the questions come in. So keep them coming in nice and fast.
Yeah, from my side, Ifani asked me to pick some stocks within my sector, and I gave her a long list. So she asked me to cover three very interesting, if diverse stocks, ranging in size. The smallest is Mustek, with a market value of 801 million. My then small cap would be Novus Holdings, market value 1.35 billion. Then my mid cap is a stock that is well known to the market, which is AfriMat, whose market value is 8.3 billion. And I think before my preamble, I know we have a quick 10 minutes to run through our selection. I think all of us on this panel know it's been a very difficult year, economically and trading-wise on the JSE. Looking at the metrics as of this morning coming online, the JSE Aussie as of this morning is down 3.23%. The small cap index is slightly better, only down 2.48%. The mid cap index is down quite a large 5.85%. And that is predominantly due to liquidity issues where portfolio managers have taken some risk off the domestic investment table, given the changes in the Reg 28 offshore investment scenario. And it's much easier to sell the more liquid mid-cap stocks than the slightly more illiquid small caps, which is why we've seen quite a big sell-off in the mid-cap market, despite many of the counters in that universe looking compelling value. So as a bit of context, with the rand this morning at 18.42, and many of us will remember, it was only a short while ago, the rand was trading at nearly 20 to the dollar. So the volatility of the currency, the stock market, yet alone the economy, with a rising interest rate environment, has not engendered the populace to rush out and look for value in these markets. But there is value out there. So I'm going to start off, if I may, with Mustek. It's a small company. Mustek is a synonymous brand in this country. started in 1987 by a Taiwanese gentleman called David Can, who sadly passed away last year. He was very young. He was only 56 from memory. And Mustek has quickly built itself up to the largest manufacturer of personal computers and the reseller of laptops in this country. So the brand is quite synonymous. And aside from being in the personal space, it has a significant business in the corporate space and in the government space as well. So as it stands right now, the stock is trading at 13.92 Rand, year to date down 3.3%. So it's very much in line with a movement in the small to mid cap index in terms of relative performance. The trading range of the year has been quite wide, from 13.20 Rand to 18.05 Rand. I selected Mustek at the beginning of this year as one of my top small caps of the year. And at one point, it hit 17.70 Rand and was up about 15%. And you got a nice dividend as well. So as it stands right now, the current price earnings ratio is a very lowly 3.7 times, which is probably one of the lowest in the universe that I track. The dividend yield is 5.5%. And the net asset value, with the share price trading today at 13.92 Rand, is quite a chunky 27.34 Rand. So why is this stock trading at such a derisory price earnings ratio of 3.7 and a large discount to its net asset value? One of it comes down to liquidity. As a small cap company with a market value of 801 million, it's difficult for institutions to actually acquire the stock despite it having compelling value. So it tends to be marginalized with only boutique funds, private clients, and specific small cap funds able to get in or get out of a stock. And the trouble is, if any fund wants to get out, the market knows there's a seller and the stock gets punished. Now, for example, last year, Camisa, the old Kagiso investment management, were large shareholders. And I think they exited about 15 or 16% of the entire Mustek shares in issue. And that depressed the share price for quite some time. Once that price had been beaten down and no more shares would be sold, the prospects of the company quickly became apparent. Now, the underlying demand for computer hardware and PCs and laptops may not be as bright and bouncy as it was during the COVID period, when we were all working from home and happily using our company's money to rush out and buy the latest printers and laptops to work from home. And that replacement cycle has to work its way through, probably in another year or two. But Mustek is nothing but entrepreneurial. So what they did, realizing that there would be a demand going forward for alternative energy, they moved into solar installation, backup power generators, and these portable power packs, which now are ubiquitous in pretty much everyone's home, either running their router or running their laptop or home PC during the rampant load shedding that this country is currently experiencing. And with a 10 billion Rand revenue, they've gone from a standing start of zero to about a 2 billion Rand revenue from alternative power. So now when you walk into any major computer hardware reseller like Incredible Connection, in the old days, you'd go in and you're happily buying your laptops, your computers, your printers. Now they're selling televisions, alternative power solutions, iPods, and all sorts of things, showing you how the market has fundamentally changed. And Mustek is moving into that space very quickly. What they've also done is moved away from just being a pure hardware manufacturer and reseller by moving into technology services, education, and software. So they're now major resellers for the likes of Oracle and Microsoft, trying to diversify their income stream. So inside Mustek, I think the market has failed to appreciate that this hardware company is now evolving into a services company where the margins tend to be quite high. We've also got an alternative power business, which is growing from a standing start extremely quickly. And I don't think anyone listening to this webcast will understand that Eskom's troubles are not going away anytime soon. We've got load shedding probably for years to come. So companies in that alternative energy space should do quite well. And of course, at some stage in the next year or two, we always want the newest, shiniest laptop, iPhone, etc., etc. So the replacement cycle from the COVID days of 2020 will start to kick in. So Mustek, for me, at 13.92 Rand, an 801 million Rand market value, a lowly PE, and a nice dividend yield, does have a few issues. The debt is quite high because it took on a significant amount of inventory to have stock in hand, particularly in power solutions. But as that inventory starts to get unwound and the debt situation starts to look a bit more palatable, I think the current PE rating of 3.7 offers scope for upside. So I have a target price on Mustek of 18 Rand. Moving briefly on to Novus Holdings, which has completely transformed itself. For those with long memories, Novus used to be the old Paarl Media, which listed at 15 Rand 50 out of Naspers many years ago and sunk like a stone as the era of print media died like the dinosaurs. And at one stage, the stock was trading at 65 cents, and it had over 4 Rand in cash in the balance sheet and a net asset value of nearly 6 Rand a share. Activists swept in, bought up the company, reconfigured it, sold off many of the loss-making operations, made the business leaner and meaner, and recently they've moved into digital education by buying the Pearson education assets. So not only does Novus now print most of the educational books used in schools and colleges in this country, but the entire spectrum of those books is now online, which means there's an ongoing annuity element because those books don't need to be updated physically so often because many things are going online. So in Novus's case, why do I like the company? Activists had clearly seen value. It's gone from 65 cents to 3 Rand 90. It recently was at a 52-week high of 4 Rand 30. Again, I chose a stock this year at 3 Rand as one of my top stocks of 2023. Year to date, it's only up 5.4%. It's off its best. It did get caught out in the Russian-Ukrainian war. Why? Because much of its paper product was sourced overseas. And as the supply chains got disrupted, the price of paper and pulp went through the roof, and they were caught short. So they had to pay up to buy the paper, to print the supplements, the magazines, and the books that we all take for granted. That is now beginning to normalize, and international paper and pulp prices are beginning to come back down, and they're working their way through the expensive inventory. So we've also got interim results for September coming up in the next couple of months, and I'm looking for a nice rebound from a 2.89 cents they reported to September last year, and they had a loss for their year ended March 2023. With a net asset value of 6 Rand 26, a prospective yield, given that this company pays consistent special dividends. And once the debt from the Pearson transaction starts to be paid down, this company will become prodigious dividend payer. And where is that dividend going? Back to the activist shareholders who own 60% of the company. So I actually like this business because the activists have an incentive to sort the company out, make it profitable, and start paying money back to themselves. With a 1.35 billion Rand market cap, it's still deemed a small cap. And I think as the market starts to appreciate the benefits of the Pearson education division in diversifying its income stream away from the old analog printing stream to the digital era of educational learning and educational streaming, Novus hopefully will catch the attention. And as a little tidbit, I was with them 2 weeks ago, and not jumping on the bandwagon, but they are going to be launching an AI tool regarding digital learning in this country, which I think will fundamentally revolutionize how children in this country will use textbooks going forward to learn, which can only be good for the economy. So my second stock is Novus at 3 Rand 90. My target price is 5 Rand 50. And I don't see a clock, so I'm guessing I'm still to time. How much time have I got left, Sammy?
We need to rush it for the last one.
Okay, I'll quickly talk about AfriMat. It's a 8.3 billion Rand, year to date up 2.1%. Recent interim results were up 4.4%, and the share price is trading at 52 Rand 43. Why do I like the stock? The market has yet to fully appreciate that the doubling in production of the Unkamati anthracite operation, which is basically high-value coal, will see a significant uplift in its earnings in the next 12 to 18 months. Secondly, the iron ore price as of this morning is at $122 a ton, which is roughly 2,250 Rand a ton. That'll keep the business humming over quite nicely. With Transnet now beginning to repair the rails, the export should pick up quite nicely. And the jewel in this company's earnings profile going forward is going to be the cement and aggregates business called Lafarge, which they bought for 800 million Rand net of cash. And it was earning 38 million rand last year, or roughly 3 million rand a month in profit. AfriMat haven't even got their hands on it yet, and is now making 12 million rand a month. And I estimate over the next 18 to 24 months, Lafarge alone could add R1.50 in value to AfriMat. So I have a private bet with the company that by 2026, this company, which earned roughly R4.58 for its year ended 2023, could earn 10 Rand a share from a combination of coal, phosphate, Lafarge aggregates, and iron ore. Now, 10 Rand a share in just over 2 years on a 52 Rand share price, to me, is compelling value for a company which is one of the best capital allocators in the country, with a superb management team. At 52 Rand 43, my target price is 80 Rand. That's my free. Novus, Mustek, and AfriMat.
Thanks so much, Anthony. We'll be watching those stocks with keen interest in the next couple of months. Over to you, Gary. So Gary Boylan is a portfolio manager at Rand Swiss. Something that you want the audience to know about you, Gary, that maybe they didn't know yet?
I don't know if the audience done anything. Yeah, so Andy talked about, I suppose, what he did before the market. So I'll tell you. He also mentioned Pearson in his answer. So years ago, I used to work for it was, I suppose, a digital tech company that did almost AI modules that delivered educational software to UK schools. It was in most of the UK schools, and it was a little kind of program that you logged into. It assessed how you were, and then it served you like kind of the correct lessons. And we were kind of instrumental in building that whole thing. And Pearson was actually at that stage one of our big competitors. And I remember sitting with them and for many times, kind of trying to understand how we could potentially work together instead of against each other. But that was years and years and years ago, before I was in financial markets. So maybe people don't know that.
So were you a programmer, software programmer? Gary?
I was an editor working with the programmer. So you ended up doing some programming, because we used to build everything at that stage in Flash and ActionScript. But yeah, we had developers. We had a whole development team in India and the UK. So a little bit of all of it.
Excellent. And your 3 stocks for the afternoon?
Okay, so I'll start with Stor-Age. So this is, you've probably seen their signs if you've been in any of the major metropolitan areas in South Africa, big red and white billboards. It listed on the market in 2015. At that stage, it had 24 properties, and they do, if you haven't used them before, it's essentially a storage business, very, very high quality. You go in there, you store your extra goods, if you're moving house, etc. All the units have alarms on them. You've got tags to enter. And it's since grown, obviously with the help of the capital markets to 93 properties now. They have a fantastic occupancy rate. So the SA occupancy sits at 92.2%. UK occupancy, because they have businesses in the UK as well, at about 85%. Rental growth is growing. One of the nice things about their rental growth is the leases tend to be fairly short. So when you have big changes, you have high interest rates, you have inflation, they typically capture those price increases fairly quickly, because there's a large degree of turnover with their tenants, so you get to reset the leases fairly often, if you want to call them leases. At the same time, it's a business that does well in turmoil. So they understand, and they've proved over the last 3 years that they're very, very resilient to crises. Mainly because when people are moving houses, when when there's a flux within society, that's generally when you go and rent storage units. You've got excess stuff. You're moving offices. You're changing offices. That's where the demand comes from. At the same time, one of the big problems in South Africa at the moment, one that, as Anthony was talking about, Mustek trying to capture is load shedding and the impact of load shedding on so many businesses, and specifically in the property space. Load shedding is absolutely key, but for a business like Stor-Age, load shedding is almost irrelevant. Their staff footprint is very, very low at the actual individual properties. You have 1 or 2 people working really just to kind of handle any walk-in customers and any kind of changes in terms, but primarily these are storage lockers. You put stuff in, you lock them, you have a couple of lights that turn on when someone arrives at the facility to walk down and open their unit, but a very, very low energy requirement. About 40% of their properties have photovoltaic systems in place. The rest have diesel generators, but not being hit the same way as so many other retail properties. As Anthony also mentioned, when you're looking at small cap stocks, one of the challenges is always around liquidity, and it's around the ability for institutional managers to go and buy into shares. And what has been encouraging, we've been a longer-term shareholder of Stor-Age, is to see that there's been a big uplift in institutional investment within the business, which is fantastic. Our business very much focused on retail clients. It's fantastic news for retail clients that have been holding it. It increases the liquidity, but it also, it serves as an underpin to the stock price. So the PIC has recently taken more than a 15% stake. The likes of Old Mutual has more than 5%. Eskom Pension Fund is around 5% as well. 91 also has around 4%. So you're starting to see real, institutional support for the stock, which is absolutely fantastic news. Longer term, if you're a retail investor and you plugging in SSS, which is the ticker, and looking at it, you're probably going to look at it and say, hey, but Gary, over 5 years, this thing's pretty flat. You've got to remember this has a fantastic dividend yield. The market cap's around 5.8 billion at the moment, but the dividend yield is just under 10%. So if you run a total return over the last 5 years, you're sitting at about a 45% return. Now, of course, that's come down from where it was, but that's also to be expected. We're in a high interest rate environment, which is typically pretty negative for property. And I think the view on why I would be picking the stock today is this: as you see potentially interest rates decreasing over the next 3 years, you probably will see an uplift in the property sector. And for us, rather than going and buying something like commercial real estate, which is obviously in massive flux, and the whole environment is changing because you've got people that work from home, you've got just the whole segment changing, to go with a more speciality REIT, is probably a more defensive move for portfolio, but will probably still benefit from the uplift should interest rates start to get a little bit better. So currently the stock is trading at around 12 rand 25. Our target price is around 14 rand, but as I said, you don't look only at the stock target, because there is that very, very meaty dividend yield that, or at least distribution that gets paid on the securities. So that's the first pick. The second pick is going to be Curro, so the education business. A little bit different now. Obviously, Curro, I think there's an incredible fundamental story behind the private education stocks in South Africa. So Curro, ADvTECH, Stadio, all very, very exciting. Over the last 3 years, they really have proved that they are a defensive business as well. With public education essentially failing and just not meeting the demand for students. These businesses have stepped in, and parents have shown that they are willing to pay for private education, no matter how difficult, no matter how constrained their ability to spend is. And I think business, at its heart, is really about solving problems. And there's no question that there are huge problems with the South African education system. And this is an opportunity for these businesses to really shine. If you look at it, you're looking at about 78 campuses, 182 schools in Curro. But the estimate is and call it just under 73,000 learners at the moment. But the estimate is that the capacity for the South African market still to absorb new learners is just under 1 million new learners that are able to attend independent schools. So that just shows that there's still a massive demand facing all of these education companies, and that massive demand can be filled by the private sector. And I think that's really where the excitement around the stock is. The stock hasn't performed particularly well over the last couple of years, and I think too many times coming to the market to tap it for cash. Obviously, specifically in Curro's case, where they focus on the primary and secondary schools, there's a large capex requirement. Building schools is expensive. You have to plug a lot of money in there, and really there's massive operating leverage within the business. So as the schools fill up with learners, as you get to kind of critical mass occupancy, if you want to call it that, hits the critical mass, you get this massive uplift in earnings as well. And I think given the difficult environment that we've been in, the market maybe got a little bit uncertain about the future of Curro, and it really has. We haven't seen the rise in the stock price. We've had 2 good sets of results from Curro recently, so it does seem like the market is the business is turning around. Some of those earnings are coming through. They have kind of reduced what they're going to do in terms of future capex, so I think the market will like. Also, of course, we had PSG unbundling the stock as well, which created a little bit of an overhang. I believe that's now through the market. And just to give you again a sense of what is possible for a company like this, if you look at private sector education in South Africa, you only have around 5% of students enrolled in independent schools. Internationally, so if you look at global averages, you're talking about 19% of of global students are enrolled in private education, so significantly lower. And if you look at a lower middle income, now sure, South Africa is an upper middle income country, but a lower middle income country, typically around 27% of learners are enrolled in private education. So there does seem to be a huge tailwind to the sector in general. And Curro has lagged the likes of AdvTECH and Stadio. In earnings terms, I mean, you're sitting on a 22 PE, which is not particularly cheap when you compare something like AdvTECH sitting on a trailing 12 month of 13. But as I said, two good sets of results. And I think back on a growth path, you want to take care of that. You want to get exposed to that high operating leverage as their schools fill up. And just remember that, it goes through the J curve that any business goes through. And for a school to mature is probably 5 to 10 years. They've put a lot of work into building up this big footprint. And I suppose, students are sticky. So once, they've been around since 1998, and, students, once they go through a schooling system, they typically take their kids back to the same schools. And there is this an economy of scale just in training teachers, etc. But there's also a brand loyalty as well, which I think they will benefit from. Final point as well, into tertiary education versus primary and secondary education. Obviously we like Stadio as well, but I think one of the maybe the moats around a primary and secondary education institution is that when you're in primary and secondary school, typically you need brick and mortar type schools. When you go into the tertiary space, it's easier to become trained digitally, remotely. And he was talking about AI training coming in. But I think there is more competition in the tertiary space from international players. You can go and do Harvard courses or Oxford courses. But when you're talking about the primary and secondary market, you really do need that brick and mortar school. You need your kids to go and sit in small classes with individual attention. And that's really where I think Curro excels. So looking for a recovery there. Definitely a buy at around 10 Rand. I think it's a buy. We obviously work quite closely with Anthony. I believe he's got a 16 Rand price target on it, and I would say that seems reasonable to me as well. My final stock in a minute and a half is Mr. Price. Now, Mr. Price has taken an absolute battering over the last little bit, and we can understand why. They were late to the party in terms of getting load shedding preparedness done. They didn't have the generators and the infrastructure, and it has cost them. I mean, they were talking about around R1 billion worth of load shedding impacting their last results. Revenue line we expect for the next year is 37 billion, so that is a significant chunk of revenue. At the same time, consumers are under an enormous amount of pressure. We know that, rising interest rates, high inflation, it's taken a lot of spending out of their pockets. 4.75% lift in interest rates, that kills anyone. But you've got to remember that Mr. Price is primarily a cash retailer. Again, also weaker currency is also not good for the stock, especially if they're importing, clothing, that increases their costs. So a very, very difficult position that they find themselves in. But I think this is really my turnaround story for the day. You're trading on a historic multiple to 12-month PE ratio of around 11 times, and that is cheap. Typically our retailers are fairly foreign held. We've seen a lot of foreign selling on our market as well, and things like this, portfolio flows change very, very quickly. I might be a little bit early on Mr. Price, so sitting at 137 Rand, I mean, there could be a little bit more weakness, but I think, you can't wait too long to start accumulating this. If interest rates start to fall, if a little bit of optimism returns, if we start seeing, a little bit of optimism from foreigners back in the South African context, you can easily see a re-rating on the stock back up to sort of a 15, 16 times earnings. That's what I think is reasonable, and that will be a significant price move higher. So yes, a difficult time for it, maybe a little bit early, but a quality company that I think will turn with the economic cycle. Obviously, they've also done the Stor-Age acquisition, which has boosted the overall numbers, but times are tough for this company, and we're looking for a change in the underlying environment that should boost the stock price.
Great, thanks, Gary. So looking for some rebounds there. On some of your picks. Thamsa Neta is the MD at Shiloh Capital. Tammy, good afternoon, and something that you want to tell the audience about yourself before we jump into your stock picks?
Much like Gary, everyone knows everything, but maybe the one that gets people the most is my younger brothers are twins. But the one that gets me the most applause is when I tell people I'm a drummer.
Yes.
So it seems to be quite an attractive statement. But yeah, seeing as we've got time constraints, let me jump straight into it. So my three stocks are Santova, Merafe, and AdvTECH. We'll start with Santova. It's a logistics business which is centered across the world with operations in Africa, Asia, Europe. They do a lot of trade services, supply chain management, and they've recently grown into digital solutions. Their key financials is that their offshore earnings are up 75%. They've got a ROE of 16% and a very low debt to equity percentage. Their NAV is about 8 Rand 30 cents per share. So as a business, they have obviously faced the headwinds of logistics demand and softening demand because of interest rates, as well as post-COVID recovery, a lot of supply side issues. Fortunately, they have gone into the right sort of sectors with their development around their digital solutions. What would be the investment rationale for this? Firstly, post-COVID uptick, the demand of and supply of services is beginning to grow, especially in the areas they operate in, predominantly Asia and Europe. Secondly, they've managed to diversify their revenue risk. So every part of the region they operate in is profitable, and the profits are growing, the business is growing in each area. The key element is the digital progress. So they are providing key supply chain analytics, which is a service section of their business, which could grow into something very meaningful. And lastly, is they're diversified across regions, which are all growing and which are all operating. So to summarize or conclusion about the stock, it's a company with a market cap of 978 million, so it's just under $1 billion, and is continuing to grow in terms of demand, is continuing to grow in terms of operations. It has great risk diversification in that its geography of operations are spread across very high trade and high supply chain areas, specifically Asia, and a new business branch, which is the digital analytics. The second stock we'll look at is Merafe, and I also did what my previous speaker did. I took a share in each sort of bracket. Merafe has got a 2.9 or round up to 3 billion Rand market cap, focuses on ferrochrome mining and beneficiation. I think one of its major issues is got its major partnerships is with Glencore, who own just under 30% of their equity, and they continue to operate in the market. I think their major issues that they face is the free float. 43% of the free float is 42 is held in South Africa. The free float 7% is offshore, and the balance is held by Glencore and IDC with 22%. So the value extraction is not that great because it's almost caused a value trap by the major shareholders, but the management has spoken about it and is looking for ways to address it. They have got a big cash balance of 1.6 billion. Their revenues continue to grow, so do their EBITDA and their operating margins. So they're showing their ability to operate and how to manage a ferrochrome business. Stainless steel demand as an investment rationale, their productivity is up. Stainless steel demand globally is also going up. They not just only mine the product, they also beneficiate it. So they go deeper into the value curve. They've had a very strong focus on the cost side of management, making sure that they don't increase their costs as they are a price taker. Commodities prices are decided outside of the commodity producers. So they are price takers and they're focused on their costing side. They have a very solid balance sheet, very little debt. They are proven operators, and they've got great partnerships and logistics and supply chain distribution through their partner Glencore. And my last stock pick is AdvTECH, sizable business, 12 billion Rand market cap. They focus on education and resourcing as a group. The primary schools, tertiary and high schools, tertiary education and resourcing. They are across the continent. They've branched out to Kenya and Botswana, so they have a strong rest of Africa portfolio. Their revenue is growing. From last year, it was 16. They've grown 16%. Operating profits has grown 23%, and they've got a great dividend of 30 cents per share. Their enrollment growth is also grown. They've gone above 100,000 students, and they continue to grow. So as a business, they've got great operating margins. They're managing in a very difficult environment, and as Gary previously stated, they've proven that parents are willing to pay regardless of the economic situation for the future of their children. They have a well-established brands in their portfolio which are known within the region, and they continue to provide a great sort of return on investment, especially with the resourcing side, which is growing quite well and competing quite well. They've got also got a significant shareholder in Value Capital Partners, who always target what they believe are not are value stocks that haven't found the value. So that is a sound check on their behalf. They've got strong cash flow generation and a sound balance sheet. But as previously said by Gary, there's always going to be concerns over the capex spend that's required to continue to build schools. But what they've shown is once the school exists, they're able to generate cash flow and do it in a meaningful way. The conclusion for this is that it's a strong portfolio. There's great underlying demand for quality education. They have a great business model. They operate well, and they're dividend paying. So that's my 3 picks. Hopefully, I saved some time.
You did. Thanks, Tammy. So just a reminder to the audience, we are welcoming questions through the YouTube channel, so please type them in there for our esteemed panel. Francois is at the back pressing all the buttons for us. So Francois, if you don't mind, maybe just put in the chat how much time we've got, because I certainly have some questions. And gents, I think what's interesting for me is that education seems to be a theme, all the way from Anthony's Mustek and Novus holdings in terms of education for them, Curro, AdvTECH. At what stage does the consumer start to say, yeah, no, things are tight, these interest rate hikes, putting up inverters and battery packs at home, inflation going through the roof. Anybody want to kind of highlight and unpack what some of that consumer risk is, even in the education space, which is seemingly quite resilient?
Yeah, I'll jump onto that. I think there's a few things that we need to remember around, especially education. A lot of people recognize, especially in the developing world which we live in, that education sets them up for a greater set of opportunities. And parents see that as well. And they're willing to commit and forego in other parts of the, call it the budget or their income, to ensure that their children have a better life for themselves. Then there's a second tier of that, which is development education, which is both parents with kids who are going to university, but as well as adults who are looking to continuously improve on their education. So in terms of the economic impact, education is one of those bellwethers where people are willing to sacrifice elsewhere. So not have DSTV, not have that extra car, have a smaller car, live in a different neighborhood, but ensure that their families or their children or themselves are able to progress through education. And as previously stated by both my colleagues on the show, that education is proven to be recession-proof, if not even pandemic-proof, where people commit to it for the long term. They recognize its value, and if the price point is in a great place and the parents see value, they'll always commit to it. So it's a unique industry. There's been a large underserved portion of the industry, which is affordable private schooling, and that is, I think, a very large part of the ask, which is being addressed to the market. And there seems to be a very high product market fit in that regard. So in the pain points that the average consumer faces, they are willing to forego certain other parts of their spending to ensure that their offspring as well as themselves have a better future.
Thanks, Tammy. Gary, maybe just a question on Mr. Price. So for you, what are some of the risks there? I think inflation has been a lot more stubborn than any of us had hoped. And even the latest announcements by both the Fed and the Reserve Bank have been fairly hawkish. I mean, is that a concern for you around how long inflation could be around and what that impact could be for the likes of Mr. Price, further squeezing the consumer and further keeping rates higher for longer?
I suppose that's a big question. That's a big question, isn't it? Everyone wants to know where inflation and rates are going, and you've got to assume that markets are pricing it. But before we get to that, and I'll answer that properly, I'm just reading a stat of Forbes at the moment. So 70% of parents say that they would take on debt just to be able to send their kids to school. So it is to Thamsanka's point, it's very sticky. But on the inflation question, absolutely. Like I said, I might be a little bit early on the Mr. Price pick because that is kind of my core thesis at the moment, that inflation is high and inflation will be brought under control. So listening to the Fed announcement last night and looking at just the pricing of where expectations are around interest rate cuts and hikes, it actually improved slightly. So the message was actually taken as fairly dovish last night. So if you look at the easiest way to do it is to go to the Fed Watch tool. It gives you an indication of the underlying federal funds futures pricing. And last night, overwhelmingly, there was never going to be any change last night. There was a 98% chance that they stayed.
Right.
That there was.
It was all in the messaging.
100%. It was all in the messaging, and I think where it's useful to look forward to is probably the March meeting. I don't know if I'm focused on the March meeting because we made a prediction that we would see an interest rate cut by March next year at the beginning of 2023. Right. It looks far more likely that the first interest rate cuts will probably come in the second quarter now. But there is, if you look at the pricing out to the March meeting, there's about a 12% chance. That was at about 7% pre-meeting last night. There's about a 12% chance now that we'll see the federal funds rate 25 basis points lower than where it is now, and there's about a 20% chance, and that was up at about 27% pre-meeting. So there's only about a 20% chance we'll now see a hike by the March meeting in 2024. So basically end of first quarter 2024. So yes, we could have interest rates higher for longer. We need to see a deterioration in the underlying economy in the US. We need to see, we've got obviously the big non-farm payrolls number out tomorrow. It's expected that the US is going to stay at 3.8% unemployment, which I'm sure when I was being taught economics at university, that was below frictional unemployment. That was it's an exceptional situation that we find ourselves in. And we have, in our opinion, we have to see that weakening. We have to see unemployment starting to weaken in the US. The labor market is just too strong. You need to see, and we saw it in the earnings season. So if you go look through the bank earnings, the likes of JP Morgan, Citigroup, etc., you can see that in the US, the consumer is exceptionally strong. And what you've seen is a reduction in savings balances, so that they are still able to spend even in a higher inflation environment, which is why you're feeling the stickier and stickier inflation. But you do get the sense that if you look at where the US debt is, for example, you do get the sense that interest rates must come down, and it just depends how fast the underlying economy reacts. But it's also important, I think, to remember that markets are forward-looking. The market is a prediction mechanism, and it is going going to lead the interest rate cycle. It's going to, significantly lead the underlying economic data, the deterioration in underlying economic data. And we get that question from clients a lot. If the US goes into recession, what will happen to stock markets? And we have to kind of say, the stock market is expecting recessionary conditions. That's why we've had stock markets down, and it's going to be more forward looking. And I think if you look at the Mr. Price share price, that is the thesis that we've taken enough pain, and we only need to see things improve slightly. We only have to see the expectation that interest rates come down a little bit more quickly, and suddenly you'll see a significant re-rating in the underlying share price. Because to an extent you've got to be contrarian. The best time to buy shares is when the worst news is out there. That's the only time you're going to get the real bargains. When everyone thinks it's an amazing stock, that's when you're going to pay too much for it.
Gary, I look at that resilience of the US economy and just watching it with envy. For the largest economy on the globe to have such low unemployment, such strong GDP growth. I mean, everybody's been expecting this US recession, and it just never seems to come. On AfriMat, for your pick, Anthony, I mean, obviously, I think everybody's looking for macroeconomic turnarounds, but I think there's a little bit more in AfriMat, isn't there? I mean, I think it's the what's going to unlock value in that stock is a little bit more than just good macroeconomics. You mentioned that maybe the market's not reading well enough into future earnings prospects. Where else do you think some of that upside surprise could come in? Maybe another good acquisition here and there. Where do you think that excellent stock that's been doing so well for so long is going to continue to surprise on the upside?
Good question. AfriMat listed in 2006, and up until the end of 2022, on a 10-year view, I'm sure my colleagues on this panel will have the data to back me up, but on a 10-year view, it was the best performing stock on the JSE, at one point up 1,800% over 10 years, where Naspers was only up 1,400%, showing you that even a small company, as I keep saying, can become a mighty acorn.
Yes.
AfriMats tend to do deals every 18 months. And having tracked this company from listing many, many years ago, every single deal that they have done, they have never overpaid. They have gone in and they've sprinkled their magic to transform the company operationally in terms of the level of the skill set, the equipment used, and the margins extracted. And Lafarge, with the French saying, that's it, we want out of this country. We are the hell in with the government, with infrastructure failing, with Eskom. We just want to get the hell out. When people want to leave the country, they give things away bargain basement prices. And AfriMat, if you take out the cash inside Lafarge, bought one of the best businesses in aggregates list or in the space for the equivalent of roughly $50 million. As I said to you, AfriMat, when they bought the business, the company was only making 3.2 million rand a month, which is Lafarge. As of right now, it's making 12 million a month, and they haven't even got their hands on it yet. So if they manage to get the profitability up to what AfriMat attains from its own construction material business, the upside is quite sizable. But interestingly, the tidbit which I gleaned from the recent results of my conversation with the CEO, Andries van Heerden, is on Transnet. Now, we all know that infrastructure in this country is falling in a heap very quickly. And a lot of that is to do with Transnet being unable to get the goods either on the rail or out of the ports. There was a stat last week that over the last 20 years, just in coal and iron ore being unable to be shipped from this country has cost this country 500 billion rand in lost export revenue. Now, given that this country this year has to borrow 550 billion rands to meet the budget deficit, it just shows you that just by improving the underlying logistics infrastructure, so much more can be done to uplift the economy, the companies, and more importantly, to create jobs.
And you think that Transnet's up for the job?
Well, interestingly, again, a tidbit. I love tidbits from companies because they're on the ground doing work every single day.
Very quickly, please, Anthony.
In the last AfriMat results, they said the single biggest uplift in construction materials was Transnet buying enormous volumes of ballast to repair the railway tracks, which they haven't done in years, showing you that they're now repairing the tracks seriously to try and get goods on the rail to get out of this country.
Great. Well, on that positive note, thank you, Transnet. We will leave it there. Thank you, Anthony. Thank you, Gary. Thank you, Tommy. Really excellent conversation, and we'll be watching your stock picks. Goodbye, everybody.